Ryan, welcome to the podcast. I really appreciate your making the time today.
Absolutely, Jeff. Thanks for having me.
Yeah, I'm looking forward to this conversation. Now, in case some of our listeners are not as familiar with CUNA, can you give us the quick version of who you guys are and what you focus on?
Yeah, Credit Union National Association. We're the largest trade group representing credit unions in the United States. There are about 5,000 credit unions serving more than 120 million Americans. And really, what we do is we advocate for them. We provide training, products, anything that they need to do that will help them improve their members' financial well-being and advance the communities they serve. That's really what we try to do, and we do that in partnership and cooperation with a network of state credit union leagues and associations. There's representation in every state, and we work together to try to make sure that credit unions are able to execute on their mission.
State organizations, that's a lot to manage. 50 states. That's a lot of subgroups.
It's turning the cats, but they really are our essential partners, and actually they founded Credit Union National Association back in the 1930s. Our membership has developed and changed over the years, but it's, I think, one of the integral parts of our success really is that we have that strong network and partnership with the state associations.
Okay. Well, you're the Chief Advocacy Officer, so I want to talk a little about what are the specific areas of focus that you guys have from an advocacy point of view right now?
Yeah, so there's a lot to talk about. I mean, what our members tell us they want us to focus on really are four areas. They want us to remove regulatory barriers so they can more efficiently serve their members. They want us to expand opportunities and powers so that they can keep up with the trends that are in the banking sector and remain relevant to their members. They want us to enhance information security so that members have confidence that when they're dealing with a credit union, their personal information is safe. And of course, we have a tax status conveyed by Congress because we're not-for-profit and we're cooperative, and our members want us to keep that so that they can continue to provide those services to their members. I mean, that's 50,000 foot, but right now in 2021 in the pandemic and everything that's going on, a couple of big issues that we're working on. The first has to do with a proposal from the Biden administration that would require banks, credit unions, really any entity that holds deposits like Venmo, even Starbucks, to report to the IRS on the inflows and outflows going into those and out of those accounts of more than $600. So we think this would present a really significant burden on credit unions, but even more importantly, it's really an invasion of consumer personal information. Banks, credit unions, employers, a lot of entities report information to the IRS.
Sure.
It's all taxable. It's all about taxable action, right? So if you're making money, your employer reports that to the IRS so they can figure out your taxes.
So they can figure out how much I owe. Yeah.
Yeah. In this case, what the administration's asking for is how much money is going into an account and how much money is coming out, which isn't related to a direct taxable event. And we've got a lot of concerns about that being an invasion of privacy, increase in regulatory burden. And then, of course, you have the federal government holding a considerable new trove of data.
Back to your InfoSec point, I guess my iPhone purchase would be on the list of things to be reported.
Well, it's gross inflows and outflows, but you're still giving them a lot of data, and they don't have a history of really holding that very well. So we're fighting that. We've won a first round battle with the House Ways and Means Committee, but there's a long way to go. Another thing that we're working on that's specific to credit unions is legislation that would make it easier for credit unions to serve underserved areas, both in terms of providing consumer access to financial services and also increase small business lending. In the last 10 years or so, we've seen, I think a net of about 7,800 bank branch closures. And I noticed Richard Hunt was on one of your podcasts, the CEO of the Consumer Bankers, and he was. I think he was kind of almost proud of the reduction in the bank branch and sort of the fast track to digitalization. But in that same amount of time, we've seen credit unions trying to fill that gap. I think opening 1,500 new branches in that same period, 2004
Oh,
to
interesting.
2020. And so what we've got is a bill out there that says if there's an underserved area, if it's a new market tax credit area, a CDFI area, or any area that
Hmm.
is more than 10 miles from a branch of a depository institution, then credit unions can add that area to their field of membership so they can serve it. And the business loans that they do in those areas wouldn't be subject to our statutory business lending cap. And our view is if banks are moving out of these communities, we want to be there for them. There are too many banking deserts as there are, and we want to make sure that we can not create any new ones, but also work to reduce the number that exist. Those are our, two of our, 60 or 70 biggest issues right now.
Only 60 or 70, Ryan? We don't have time for all 60 or 70.
We're not bored.
I I love this idea of serving underserved communities. I'd love to understand kind of the motivation behind it, because it's both challenging, I think, operationally, credit-wise, the credit decisioning becomes more challenging. Figuring out where you can actually extend credit in more underserved communities is typically, it's a riskier area in general, and you've got to have good analytics. But it's also usually not as profitable. So I'm curious kind of what's driving the credit unions you're talking to that direction and wanting to fill that, because I can understand from a business point of view how it's hard to justify and why you can see closures in areas where there's less traffic, less business, and therefore less profitability.
Well, I think, Jeff, it starts with the credit union mission. In our statute, Congress has told us that we are supposed to promote thrift and provide access to credit for provident purposes, and we do that through a not-for-profit cooperative model. So what we are looking at isn't only the bottom line. Obviously, we have to remain solvent. We have to operate in a safe and sound manner. But we also have this mission, and for credit unions, large and small, that's the reason that they exist. They exist to serve their existing members and also to bring the opportunity for savings and the access to credit to folks that may not have it.
I love it. It's the same thing that got us into the financial services space. How do you apply new models to enhancing access to credit, the cost of credit, and I will say it's one of the things as I've worked with credit unions I've really appreciated is the focus on consumers. I mean, even just the word member kind of feels different than consumer, which is what you often hear from other FIs or customer or client or whatever it is. And when you look at the balance sheets, certainly. I did not appreciate this when I first got into financial services, and we were like, oh, there are more assets at the banks. We should work with banks, which I don't want to diss banks. But if you look at consumer lending, the credit unions are disproportionate on how much of their balance sheet is allocated to various kinds of consumer lending compared to the banks. And I'll say punch above their weight class from a assets on balance sheet point of view versus a lending point of view to the consumers. Are there issues on the consumer lending side that you hear from your members or focuses? I know there's kind of shifts in product and COVID has changed a lot of stuff. What are the trends you're seeing in that space?
Well, during the initial part of COVID, of course, credit unions were pretty active lenders in the Paycheck Protection Program and really trying to work to keep employees connected to their employer. They're also working to make sure that folks are able to stay in their homes, right? So if you think about the typical credit union is serving members of all income brackets, but the folks that need the most help right now tend to be in the low and the moderate income areas. Yep. They're folks that may be frontline workers, and so I think if there are trends, and particularly trends coming out of COVID, it's how can we help bridge these folks to the end of the health pandemic, but also the end of the economic pandemic. And make sure that they continue to operate in what's really becoming a K-shaped recovery. So you'll see credit unions, I think, looking to make sure that they are, trying to do what they can to keep their members out of foreclosure, keep members who may be renters from being evicted as those protections fall on the wayside. You're seeing, I think, some, very much some interest, particularly on the policy side, in terms of credit cards and debit cards, and making sure that the systems that support the offering of those cards and certainly the interchange revenue that goes on it is able to continue. So there's a lot going on there, and of course we could get into some of the things they're thinking about from digitalization and trying to anticipate where members are going to need to be, in 2, 3, 5 years' time. Absolutely.
Well, how do you think about, I mean, it was interesting that you brought up the addition of branches in underserved communities in recent times, which is not, frankly, not a trend I've been aware of. And certainly what I hear from everybody is like, digitization is coming, we've got to get there fast. How do you see those two trends playing, and where do you see the demand for digital? Like, how are the credit unions viewing that, and is it different than what I might see at other financial institutions?
Well, I think it's complicated, right? Of course, we've seen through this pandemic that there's been an acceleration of the deployment of digital technology. You think about the contactless card. I just got, a contactless card for my credit union. I use an Apple Card as well, so I've been, dabbing or, touching, for a couple of years now. And that's become more mainstream, and credit unions are active in that type of deployment. But what we hear from, surveys that we do of consumers, focus groups that we do of consumers, is that throughout all age groups, there still is a desire for and a perception of security with the face-to-face interaction. And one of the things that we had to scramble with, and I think a lot of folks had to scramble with at the very first part of the pandemic, was the fact that for public health reasons, branches were closed, and we had to figure out how to keep a financial institution open in an environment where that face-to-face action was more difficult. Another thought on this, and again, I don't think it's one or the other, digital or branches, right? But if you think about the demographic that credit unions primarily serve, low to moderate income individuals, we think everybody has a mobile device or a computer or access to high-speed internet. It's simply not the case, right? So a rush to digital and sort of mobile banking that is ubiquitous and perhaps the only way that one could access it really could end up leaving out a number of folks that are vulnerable. So I think that plays into a part of it. And then for credit unions, they have traditionally operated very locally, right? And in more and more communities, they are the financial service provider of record in a small town or county or rural area, or a neighborhood in an urban area. And there's a connection there that I think is important for the members of the institution to continue to see.
Are there areas where you see, like, it's interesting that kind of hybrid nature you talk about, where the nature of in-person is important? Are there areas where you do see, where digital is going to be most valuable and maybe not competing with the in-person, but kind of where it's additive to and kind of, complementary to? Well,
yeah, and I think you have to keep in mind that not all digital innovation is something that's going to be member-facing, right? So there's a number of things that are going on in the back office and in the background. We've had a group that we've organized at CUNA of credit union system leaders that has really tried to figure out what would a roadmap for the industry look like, and how could it help support a credit union's path in this area. They're really focusing on how credit unions might be able to use analytics and artificial intelligence, particularly in underwriting, how we can use sort of a digital approach to empower employees. One of the things that credit unions do, I think, pretty well is try to tailor products to the needs of their members. So it's not, if you don't fit all the criteria in a box, then the answer is no. We try to get to yes. And so how can you use sort of digital technology to get to yes? And that helps, of course, to deepen the relationship with members. And then also looking at ways to optimize operations. I think that's where there's big bang for the buck from a credit union perspective. So those are some of the big themes that they're addressing, and how I can sort of see it playing out.
I'm kind of curious. You hit on something near and dear, obviously, to our hearts, in the use of AI and ML, particularly in credit underwriting, but I think in lots of areas within NEFI. I know the banking regulators put out a joint statement. There's kind of everybody's trying to better understand what this means, how you think about it, how it fits into third-party governance or model governance frameworks or kind of historical regulation. Are there things you're seeing motions from the regulators around understanding this in the credit union space? Are there things you think they could or should be doing, or we could or should be doing to help them, understand the potential and give? I think clarity is the thing I hear most in terms of how oversight needs to work in these kind of models, because the regulations weren't really written with this kind of concept in mind.
Well, you've answered your own question. If they're going to regulate in this area, then there needs to be clear guidance. We need to have, well-developed, acceptable definitions of what we're talking about when we talk about artificial intelligence or machine learning. And then I think the other thing is, I think the regulators need to avoid disrupting the operation of the credit union. So if AI and ML are tools to try to get to an outcome, avoid disrupting the other steps or over-regulating or having redundant regulation, to the other steps of that process. Those would be, again, I think everybody's trying to get their hands around it, but it starts with some really clear guidance from the regulators, and they ought not to be operating simply in a vacuum or on an island, if you will. Engaging with the Fintech sector, engaging with FIs, I think is really critical to come to those common and accepted definitions.
Yeah, we're fingers crossed that we see motion on that front. I think that would fall into your removing barriers category of your kind of 4 high-level things your members want you to say. I took notes, and I remember what you said.
If it's not removing barriers, it's certainly keeping new barriers from being
new barriers. What are the other kinds of barriers so I kind of want to go back to your 4, at least the first 2. What are the other kinds of barriers that you're focused on removing or that you think are hindering the ability of credit unions to serve their communities better?
Well, here's the thing. I think just for your listeners, credit unions are regulated primarily at the federal level by the National Credit Union Administration, which is our safety and soundness regulator, our insurer, and then, of course, the Consumer Financial Protection Bureau. One of the things that we're concerned about at NCUA is that the chairman there, Chairman Harper, would like to increase the normal operating level of the insurance fund. Basically, what that means is he wants to have the insurance fund hold more credit union member deposits to provide, a buffer between the fund and the insurance and the taxpayer. Fair enough. Congress has said that buffer should be around 1.3% of insured shares. He wants to take it, I think, north of 1.5, closer to probably 2.0, sort of in the same direction the FDIC fund's headed. We don't think that that's necessary. Here's the deal. The credit union fund has remained solvent from its start. Even during the financial crisis, it didn't go into insolvency. It's remained solvent. And so we think there's a good balance there. So we're concerned about that because if you require more money to be reserved, that's less money that credit unions have to help their members.
To lend, yeah.
That's one high-level concern there. Also at the agency, though, we'd like to have we've learned some things during this pandemic. And one of the things that we've learned is that they don't have all the tools they need to help credit unions through crises. So credit unions went into the pandemic very well capitalized. Average capital ratio was close to 11%, if I recall correctly. Of course, with the government assistance and the reduction in lending, we've seen a lot of change in credit union balance sheets. That capital level has gone down. And some otherwise healthy credit unions have approached levels that 7% is our very well capitalized level. They're approaching 7%. If they get below 6, NCUA's got to take prompt corrective action. We think the agency should have some tools in its toolbox that allow it to work with credit unions on an individual basis so that they don't have to take PCA steps simply because there is some national or global crisis or even a local natural disaster impact the balance sheet. So we're trying to work with the agency to ask Congress for that authority. At the CFPB,
I was going to ask. You named 2, and then you picked on one a little bit. I was going to ask about the CFPB, which is obviously the regulator I'm most familiar with.
Yeah, I mean, I think the most succinct way is we'd like to see nothing change, but we know that's not going to happen. We've got Rohit Chopra, who is about to get confirmed by the U.S. Senate, and once he's in office, I expect that the Bureau is going to take some pretty aggressive regulatory action. Our concern is mostly on the rulemaking side because NCUA supervises most credit unions for compliance with consumer protection regulations. So the rules matter for us. The rules also frustrate us because I can't think of a single rule that the CFPB has ever written or changed that has been done because there has been bad activity in the credit union system. So every time there's a change, we've got to change how we're doing. We got to spend money on complying with the regulation, updating our processes, training staff, etc. And it's all because somebody else was engaged in some activity that prompted a rule change. It robs credit union members of money that could be used to better serve them. And so we're sort of girding for a lot of frustration in the next several years, and we'll be very actively engaging the Bureau to try to keep things as close to the same as they are right now as possible.
The second guy who's told me close to the same is what they want out of the Bureau. So
it's a weird time.
And I do think it's an interesting point you raised because it's easy to forget the costs of compliance with rules that seem common sense. You can say, well, that's a reasonable rule. And then you go, well, the cost of actually training staff, updating systems, maybe collecting information, reporting information is not trivial. And it really imposes a burden on those who have to comply, even if they're not breaking the rule in the first place.
Yeah, and then there are the unintended consequences. And I'll just give you one example: is the CFPB's remittance rule. I'm sure that there was a strong argument to be made that there needed to be new rules written around international remittances. I think the Dodd-Frank Act might have required, or at least pointed the Bureau in the direction of updating those rules. The impact of what the CFPB did was to say, well, what the impact was, it drove half the credit unions either out of the market of international remittances or reducing their offerings to stay below a very, very low threshold. And so what that meant was you had entities that weren't causing a problem, that were actually serving folks and offering good and safe products, who exited the market and sent those consumers to the entities that were causing the problem. Now, they have to operate now under a new rule, sure, but you took the good guys out of the market. And, that is the real rub with the Bureau, is oftentimes they have one-size-fits-all regulation, and the impact on small providers, whether it's a small credit union or a community bank, can be just simply getting out of that market. And that's to the disservice of consumers. That's not consumer protection.
Interesting. And now your other area of your top four, your second area was expanding opportunity. We talked about, the ability to go into underserved markets, open branches where there wasn't local FIs, which I thought was a really interesting concept and an idea that you guys could, bring credit unions into underserved markets in a way that, expanding their field of membership and removing certain statutory caps on interest rates. Are there other kinds of expansion of opportunity that either from the policy point of view or just generally you're hearing that credit unions are looking at right now?
Yeah, one that comes to mind, and I think just for context, I'd say, the Federal Credit Union Act is very prescriptive and restrictive, right? So it provides a very limited amount of powers that credit unions can do, and it has a list of of things that credit unions can't do. One of the areas that is restrictive is the maturity limit of loans that aren't mortgages. And the Federal Credit Union Act limits federal credit unions to a 15-year maturity limit. And that has an impact on all sorts of loans, including some commercial loans, student loans, and others. Every state charter in the country, except for I think Oklahoma, has a more permissive maturity limit. I'm not even aware that there's a maturity limit in any of the relevant banking statutes. The So one of the things that we're also asking Congress is to, give the regulator some flexibility in sort of setting whatever should be an upper limit on maturity
length
limit for a loan. So, that's one example. But I think broadly, there are a number of areas where over the years, Congress has written it very specifically or prescriptively that we're looking at, okay, we're in the 21st century now. We have a well-established regulator. We're regulated also for consumer protection. Perhaps the law could be a little bit more general to provide the regulator and the tools it needs to regulate the activity.
Got it. I like it. That's it. I was not aware of that. See, I'm learning here on the podcast myself. It's my favorite part. And then one other area I wanted to touch on was, obviously Upstart's in the business of partnering with FIs. I know that the topic of fintech partnerships is kind of top of mind for many in the industry. What are you hearing from strategically how your members are thinking about that, and what's your advice for tech players or fintech players that are interested in partnering with credit unions, and how we can be better partners or make that process easier for your members?
Yeah. No, my advice for fintech is don't sleep on credit unions. I think that it is it's just sort of inherent in the credit union model that we are cooperative and we are collaborative. Certainly that's the case within the system, but there's also a number of examples of that taking place outside of the system. And I'll mention a couple of really big ones. I mean, you have a nationwide system of shared branching that has been in existence for decades, run by Co-op Financial Services. And that gives credit union members the ability to access their account wherever they are in the country. It's an awesome example of not just cooperation, but really early days digitalization and fintech application. Similarly, you've got QSOs like CU Direct that help credit unions collaborate with auto dealers to do indirect auto lending. And even some credit unions are working with Google on the application of Google Pay and access to deposit accounts. So I think there's and there are many other examples, I'm sure. The point is there are credit unions out there, and I think most of them would say their way to go about digitalization and remain relevant is through partnership with fintech. I think where we would have some concern just on the policy area is, what we want to avoid is sort of a rent-to-charter situation where fintech is using a credit union or a bank to try to circumvent regulation or a regulatory framework. From an advocacy perspective, where I put a lot of my focus, that's our concern. But from an operations perspective, what I hear from credit union leaders is there's a great eagerness and appetite to partner with fintech and to find ways to do more.
Well, I will echo Ryan's sentiment for any fintech executives listening that I think we underlooked the credit union market for a while to our detriment, and have realized the opportunity in partnering with credit unions.
Jeff, one of the things that I just noticed, perhaps one of the obstacles might be knowing how to engage the system. And I just offer Credit Union National Association. You can contact me. I'll do what I can to help put folks in touch with people that are interested in this, and would love to facilitate the conversation.
That would be great. So I'm sure we'll have some people take you up on that. And yeah, I think you're totally right about where this is headed. The rent-a-charter comment is interesting, because I think it's interesting to me that fintech partnerships are seen as so new, when practically speaking, almost all the technology in place at credit unions or banks is not built in-house. It's like, there's established technology players in the FI space, and now we think fintech partnerships, it's new. I go, what do you think Jack Henry is? It's a technology company that sells technology to, or so many.
You can't have a nationwide shared branching network if you don't have some sort of technology behind that. So, and that's been going on for years.
So I think it's new, but it's also kind of in many ways the oldest version of the technology partnership with banks.
Yep.
Ryan, before we wrap up, is there anything you expected to ask, wanted me to ask that I didn't get to? The topics you think we should have hit on that I missed?
No, this is great. I really appreciate you having me on the show. I've listened to a couple of the podcasts, and I think I'll probably be a more regular listener going forward. So
Excellent.
so much for that.
Yeah, well, if you're a regular listener or you've listened to a few, then you know that I always end with 3 questions.
Okay.
Oh, you didn't listen to the end. You got to be careful. I didn't put these on the sheet I sent you, so you're going to have to fire them off the fly.
Okay.
But you kind of rapid fire at the end. But what's the best piece of career advice you've gotten?
Ask for forgiveness, not for permission.
Ask for forgiveness, not for now. And the only thing I'll add to that is you got to mean it. People tell you that in certain companies. They say, here's the place you should ask for forgiveness and not permission. And then it turns out you definitely should have asked for permission. So I think the corollary to that is build a company that appreciates people who ask for forgiveness and not for permission. I like that one. What's the best piece of advice about consumer banking or consumer lending you've gotten?
The best piece of advice about consumer banking or consumer lending that I have received is...
Or given, if you want to go that way.
Well, is of course go to a credit union.
That's where I started my financial journey at a credit union. It's true. Go to credit union. All right. We'll accept that answer. It's well played. Well played, sir. And then my last question is, what's a bold prediction for the future? It doesn't have to be government or policy related, though it can be, but what's a bold prediction for the future?
Bold prediction for the future.
Yeah, so I can bring you back in a year or something and tell you if you were right or wrong and pick on you for it. Or congratulations.
I think that at some point in the future, and this may be 10, 15 years down the road, that the CFPB will be a multi-member bipartisan commission as was originally proposed by Barack Obama and Elizabeth Warren.
Is that a prediction or a hope?
Well, it's both, but I think that it'll happen.
All right. CFPB moving to a multi-member commission instead of a singular director. A nice bold prediction. That one's very clear. It won't be difficult to tell if you're right or wrong. It would just maybe the time horizon is the question. All right, Ryan, I appreciate you joining us today. Thanks so much. It's been a fascinating conversation.
Hey, Jeff, thanks for having me.
I've enjoyed it. Thanks.